52% of U.S. corporate pension funds are legally required to hold fixed income. Not because they want to, but because they have to. Now, since 2009, pension funds have shifted 14 percentage points away from stocks and into bonds. The number of plans holding more than half their assets in fixed income has tripled. Now, this isn't investment strategy, it's regulatory handcuffs. The municipal bond market alone, $4 trillion. Insurance companies are mandated by law to file every unrated municipal bond with regulators for credit assessment. Now, they can't just buy whatever makes sense. Property and casualty insurers, they hold $263 billion in muni bonds. Life insurers hold $218 billion. Why? Well, tax advantages, regulatory requirements, but here's the real kicker. Total global debt just hit a record $318 trillion. That's government and corporate bonds combined. The entire Bitcoin market, it's only $2 trillion. We're talking about 159 times more money trapped in traditional debt than exists in all of Bitcoin. And here's what's killing these investors. The M2 money supply that I talk about all the time, it's grown from 4.7 trillion in 2000 to over 22 trillion today. That's a 467% increase. Now, do the math. That's roughly a 10% monetary debasement every single year. Meanwhile, your safe muni bonds, they're paying you what, 5% before taxes? So you've got millions of retirees whose pension funds are legally forced to lose purchasing power every single year. And the lower their funding status gets, the more bonds they're required to hold. It's a death spiral with a regulatory mandate. Pension funds, of course, they want out. Insurance companies, they want out. Muni bonds investors, they want out. But the mandates keep them locked in place until now. Because what if there was a way to meet these exact same mandates while actually making money? But here's the deeper problem. Traditional credit markets, they're not just underperforming, they're fundamentally broken. Remember back in 2008, the great financial crash, right? Credit rating agencies downgraded 4,485 collateralized debt obligations in the first quarter alone. Now, these were supposed to be safe. They were supposed to be safe investments that had been packaged and repackaged until nobody could even articulate what the risk was. 50% of AAA rated CDO tranches got downgraded to junk status by 2010. The rating agencies, they had no idea what they were even doing, what they were rating. That same bundled complexity, it's everywhere now. Commercial lending is 16.4 trillion and growing. Sovereign debt, 12.3 trillion in new borrowing just this year. Add muni bonds, corporate debt, mortgage-backed securities, all of it packaged, all of it bundled and sliced into tranches that make the original assets impossible to even value. Now, when one loan defaults, you can't tell which other investments are going to get hit. And here's what's crushing everyone. Interest costs as a share of economic output just hit the highest level in 20 years. Between 2021 and 2024, debt servicing costs went from the lowest to the highest in 2 decades. But investors, they keep bidding up bond prices anyway. Why? Again, because they're mandated to buy this stuff. Pension funds, insurance companies, muni bond funds, they have no choice. So you've got desperate buyers bidding up prices of increasingly risky assets. Classic yield compression. Everyone's racing to the bottom, accepting lower and lower returns for higher and higher risk. Total outstanding government and corporate bonds globally, over 100 trillion. That's larger than global GDP. But nobody can actually tell you what's in these things anymore. Commercial mortgage-backed securities, collateralized loan obligations, muni bond insurance, all wrapped around muni bond insurance. Now, this is 2008 all over again, except bigger. The CDO market peaked at 2 trillion before it imploded. Today's credit market, 50 times larger. The system is drowning in complexity. Trillions of dollars trapped in instruments that nobody fully understands, paying yields that don't compensate for the actual risk. But what if there was a completely different approach? What if instead of bundled complexity, you had radical simplicity? Now here's what Wall Street doesn't want you to know. Of course, Their margins are terrible. BlackRock, the world's largest asset manager, charges 0.45 to 0.52% annually on their bond funds. That's less than 0.5% per year to manage money. Muni bond underwriting, about 0.37% per deal. Corporate bond underwriting, even thinner. Now, these spreads have been in a 15-year death spiral. Competition is driving these margins towards zero. It's gotten so bad that Citi and UBS just exited the muni bond business entirely. The margins, they couldn't support their operations. As one industry insider put it, you get to a point where spreads are so low that the margin on a deal for an underwriter becomes thin, but there's a floor. They're desperately trying to stay profitable by getting more efficient, better technology, lower costs, automated processes, but they're still just fighting over breadcrumbs. When your margins are this thin, you can't innovate. Every dollar spent on research and development comes straight out of profit. So they're stuck. They're trapped in a commodity business with no way out. Now, the smartest firms, they tried to escape and do private credit. Higher fees, less competition, but even there, margins are getting compressed as more players crowd in. So let's recap here real quickly. First, Wall Street's best case scenario, 3 to 4% total margins on a good day. Annual management fees under 0.5%. Underwriting fees about 1%. Okay? That's the problem. Now, imagine an alternative. What if instead of managing other people's money for tiny fees, you can create instruments that let you keep 50% of the upside? What if instead of fighting over basis points, you could capture the appreciation of the hardest money ever created? Well, that's exactly what Michael Saylor has figured out, and it's about to make traditional financial margins look like a rounding error. Now, here's the breakthrough that changes everything. What if you could create financial instruments that pay junk bond yields but qualify as investment grade under existing regulations? Investment grade means rated BBB or higher by the major agencies. That's the threshold that pension funds and insurance companies and muni bond investors are required to meet. And Saylor figured out how to hack this system. Instead of backing bonds with unpredictable cash flows, back them with Bitcoin. Take Strategy's STRF, Strife Preferred Shares. They pay 10% annually. That's more than junk bonds. And here's the key. They're backed by Bitcoin holdings worth 10 times the face value. Now, traditional corporate bonds, they're backed by business cash flows that could disappear overnight. Muni bonds, they're backed by tax revenues that fluctuate with the economy. But Bitcoin-backed instruments, they're backed by the hardest money ever created. Strategy even created new metrics to prove this, like BTC risk. That's the likelihood of under-collateralization at maturity. Or BTC credit spread. That's the yield required to offset the Bitcoin risk. Now look, this isn't theoretical. This is regulatory arbitrage at its finest. These instruments fit perfectly into the existing investment grade boxes that mandate investors are required to fill. Pension fund managers have a legal duty to maximize financial benefits. Insurance companies must invest in sufficiently rated securities. Muni bond funds need investment grade paper. Now, Strategy's Strike, STRK, it pays out 8% with convertibility. Strife pays 10% cash only. And STRD Stride pays 10% as the highest yielding option. Now, compare that to traditional investment grade bonds paying 3 to 5%. Now, this is the same regulatory approval, same fiduciary compliance, but it's double the yield. It's backed by an asset that's been appreciating at 60% annually for over a decade. Now, again, this isn't just a better mousetrap. It's a completely different category of financial engineering. And here's why Wall Street can't compete with the math behind it. Bitcoin's compound annual growth rate over any 4-year rolling window, the minimum, it's been 24%. The average, about 65%. Now, since inception, Bitcoin has delivered a 140% compound annual return. Even being conservative, let's just use 60% annually going forward. Strategy's preferred shares pay 10% coupons. Bitcoin appreciates 60% annually. That leaves 50% retained profit margins. Now, compare that to Wall Street's 3%. Now, look, this isn't theoretical. Recently, a real estate investor in Toronto deployed this strategy, borrowed $100,000 against a rental property cash flow, bought Bitcoin, generated an additional $859,000 in just 10 years. Now, traditional finance fights over basis points. Bitcoin treasury companies, they capture 50 times higher margins. Now, the math is so compelling that Trump Media, GameStop, and dozens of other companies are now announcing Bitcoin treasury strategies. Corporate treasury adoption has entered a new phase. Companies whose primary objective is Bitcoin accumulation are purpose-built from the ground up. And this is how capital always works. Money flows to the highest risk-adjusted returns. When one strategy delivers 15 times better margins than the alternative, capital moves. And here's the beautiful part. Every successful Bitcoin treasury company proves the model works, making it easier for the next company to get funding, get regulatory approval, get institutional backing. And Wall Street's been optimizing around 3% margins for decades. Bitcoin treasuries, they just showed them what 50% margins look like. $10 billion raised in just 4 months. $6.6 billion through their ATM equity program, $2 billion in convertible notes at 0% coupon, $1.4 billion through their new preferred instruments. I mean, this is industrial scale Bitcoin acquisition. But here's where it gets really interesting. Remember those precision straws I talked about? Saylor didn't just build one, he built the entire assembly line. Strike for income investors, 8% perpetual coupon, convertible at $1,000 per share, launched in February, already trading 22% above IPO price. Strife for institutions, 10% perpetual preferred with no dilution to shareholders. This is permanent capital with no refinancing risk, no covenants, no collateral requirements. And now Stride, their newest instrument targeting specific institutional mandates. See what's happening here? Each instrument is a different precision tool targeting different pools of trapped capital. Pension funds that need steady income, Strike. Insurance companies that need yield without equity risk, Strife. Municipal treasuries with specific mandates, Stride. It's like having 4 different drill bits for 4 different types of rock. Now, Wall Street loves to dismiss this as just another crypto play, but look at this correlation data. 98% correlation between Strategy's stock price and their Bitcoin value per share. Now, remember those Wall Street margins we talked about? Like BlackRock makes 3 to 4% on placement fees. Strategy's making 50% profit margins because they're not just managing money, they're converting it into the world's hardest asset. And here's the kicker. 100% of their Bitcoin remains unencumbered. That's pristine collateral that can backstop every future instrument they create. And this isn't just happening in the US. Over 80 public companies have now adopted Bitcoin treasury strategies. Metaplanet in Japan just announced their $5.4 billion 555 million plan. The playbook Saylor debugged is being replicated globally. Metaplanet's target of 210,000 Bitcoin by 2027 is roughly 1% of the total supply. The same concept as strategy, different regulatory framework. Now, this demonstrates that the model scales across different markets. American companies are accessing US credit markets, while Japanese companies are accessing Japanese bond markets. Both are converting trapped capital into Bitcoin using instruments that meet local regulatory requirements, which brings us to the supply implications when this scales globally. Now, here's the math that's hiding right in plain sight. Okay, so Bitcoin has a hard cap of 21 million coins. 19.7 have already been mined. That's about 94% of the total supply. But the effective supply is much smaller. Between 3 and 4 million Bitcoin are permanently lost, forgotten passwords, destroyed hard drives, whatever, right? The true circulating supply is closer to about 16 to 17 million Bitcoin. Now, the new supply is shrinking really fast. Only about 164,250 Bitcoin will be mined just this year. The halving schedule means that this number keeps getting smaller. Now, if we look at the corporate demand, public companies alone hold over 725,000 Bitcoin. That's more than 4 years of new supply. Private companies hold an estimated 300,000 more. Now, corporate purchases in 2025 have already exceeded the entire annual mining output. Now, this is just beginning. The regulatory barriers are just starting to fall. The strategy playbook is replicating globally. Metaplanet in Japan, new companies announced weekly across Asia, the Middle East, North America. I mean, run the numbers forward. If just 1% of the 300 trillion global credit market rotates into Bitcoin-backed instruments, that's 3 trillion, chasing 21 million coins. We're seeing the early stages of the rotation right now. Credit rating agencies are starting to recognize Bitcoin-backed debt as instrument grade. Institutional mandates are beginning to approve these instruments. And this isn't going to happen gradually. Supply shocks in fixed cap assets happen suddenly. Each successful corporate issuance proves the model. Each regulatory approval opens new pools of capital. Now consider this. Strategy alone targets $84 billion in Bitcoin purchases by 2027. Metaplanet targets 210,000 Bitcoin. Now that's before we count the dozens of other companies building similar programs.